Good day, ladies and gentlemen. I am Saradeep, your moderator of the session. Thank you and welcome to the Grant Thornton's webinar on UK-India transfer pricing update. For the duration of presentation, all participants' line will be in listen-only mode. We will then have a Q&A session at the end of the presentation. It's indeed a pleasure welcoming our speaker for today. We have with us Ms. Wendy Nichols from Grant Thornton UK and Ms. Anuj Kumar from Grant Thornton UK. We also have Ms. Vaishali Mani, Chartered Accountant from Mumbai. I would like to now hand over the conference to Ms. Wendy Nichols. Thank you, and over to you, ma'am.
Thank you very much, and welcome everybody to our webinar. What we're going to be covering today is going to be an update on some of the new rules on country-by-country reporting and transfer pricing documentation. And as you can see from our contents there, we're going to start at the high level with CbCR and master file, looking at the global and UK landscape. Then we're going to turn over to the Indian landscape where we've got some very new developments, and Vaishali is going to tell us about the new rules 10DA and 10DB that we're all going to become very familiar with, I guess, over time. Then we will look at the master file contents and do a little bit of a sort of compare and contrast between the two. And towards the end, we will pass on some of the considerations and challenges that we've been hearing from our own clients that may be relevant to some of you. We will allow some time towards the end for questions, and just before we leave, there will be some polling questions, one of which is to say that you would like a copy of the slides, so to stop you scribbling frantically as we go through. So just to introduce ourselves again, I'm Wendy Nichols. I'm a partner in the UK firm, and I'm the EMEA leader for Grant Thornton Transfer Pricing. Vaishali is a partner in our Indian firm, and she's going to cover the India-specific angles, and Anuj Kumar from our UK firm is also going to join and talk about some of the OECD rules and the UK rules in more detail. So, turning on now to slide 6, which is just the starting sort of general picture of how we got to here. Why are we here? Why did we get to this point? Well, as we are all very familiar, we've been going through the base erosion and profit shifting, the BEPS project for some time. The final reports were issued in 2015, so a little while ago now, but developments have been happening all since then. The main thing to say about transfer pricing documentation, and indeed when you're looking at the BEPS rules generally, is that some of these rules are red lines or minimum standards, and some of them are more best practice. And the issue for documentation is that the country-by-country report is a red line. So that means that all countries who've signed up to this have pretty much agreed to do the country-by-country report in the same way, with the same thresholds, and to exchange them amongst themselves. And this is supposed to be a risk assessment tool for the tax authorities. So if you start, as tax authorities around the world start getting hold of your country-by-country reports, if you're an eligible business for that, so if you meet the size thresholds, then if you start getting questions about, well, surely you should be paying more tax here because of the level of turnover or headcount or whatever it is, then you need to push back and say, actually, this is a risk assessment tool. This is not to be assessing tax for tax authorities. The main elements of the documentation, though, and this will apply to nearly all of you, are that you now have to have the group master file as well as local country files. And the master file has high-level information about the group. Now, the reason for this, of course, is that tax authorities felt that they were getting a raw deal in the past because taxpayers and multinational groups knew more about their business, clearly, than the local tax authorities in the various countries. So they wanted to get hold of some general information about the big picture. That's why you have all this stuff about the supply chain in there, because they want to see how they fit into the whole. So this is different, and this is where we start to get some divergence. And some countries have put numerical thresholds, some countries have put special information that they want in their master file, and we're going to come on to that later on. The local country files we're not particularly going to talk about today because we haven't got time to go through those in detail, but suffice it to say that the local country file is supposed to be the detailed rules and the detailed information for your entities in a country. In the UK, we're pretty much following the OECD standards, so if you're looking up on the OECD guidelines what do you need in a local file and you do that for the UK, you should be all right. In India, we have not moved away from the previous transfer pricing documentation filings that you've had to do. So anything that we talk about today is extra, okay? It's not instead. So just worth mentioning that. Now, what I'd like to do now is to hand over to, move on to slide 7 and hand over to Anuj, who's going to tell us a little bit about CbCR and Masterfile and how the UK journey has processed.
Thank you, Wendy. CbCR was seen as one of the minimum standards commitments given as part of the OECD STEPS process. So far, 57 countries have implemented country-by-country reporting. This includes the UK, whose Treasury regulations were passed in February last year. They will apply for the counting period starting on or after the 1st of January 2016 and will apply to multinationals with an annual consolidated group revenue of 750 million euros in the immediately prior year's financial statements. Now, previous guidance suggested that the threshold should be 586 million pounds rather than the euro amount now specified. The report itself must be filed 12 months from the end of the accounting period. Now, just to think about it for a second, having a euro-denominated threshold means that the threshold for UK companies will change every single year. So how do the other two tiers fit into the UK? Well, UK tax legislation regarding transfer pricing should be read alongside the July 2017 OECD transfer pricing guidelines. Transfer pricing falls within the UK corporate tax self-assessment regime. Other than country-by-country reporting, transfer pricing documentation does not actually have to be filed with HMRC in the UK. Transfer pricing documentation is covered by the new Chapter 5 of the new OECD guidelines. However, HMRC are not currently making this a mandatory requirement in the UK to prepare master file and local file in line with the OECD recommendations. That being said, it is already widely considered as a best practice, and therefore departing from the OECD guidelines should only be done with good reason. Now, moving on to slide 8, HMRC have gone on record to say that they do not want to overburden taxpayers with disproportionate compliance fees. For this reason, they have introduced an exemption for small and medium enterprise groups in the UK. The rules are complex and have many exceptions. However, at a high level, to be considered small, a group must have 50 or less employees and be below at least one of the annual turnover or balance sheet tests. Being a small group would take you out of the transfer pricing regime for UK purposes. Similarly, to be considered medium, a group must have 250 or less employees and be below at least one of the annual turnover or balance sheet tests. Most medium groups are outside of the UK transfer pricing regime. However, they may have to prepare transfer pricing documentation in the UK upon request. You will see later that these thresholds are very different to the Indian thresholds. I'll now hand over to Vaishali, who will discuss country-by-country reporting and the master file in an Indian landscape.
Thanks, Anuj. The CbCR and Masterfile regulations were introduced in India by the Finance Act 2016. Though the legislation was in place, the detailed rules with regards to Masterfile, the contents of the Masterfile, the contents of CbCR, the filing process, was notified via draft rules on 6th of October 2017, and it was kept open for discussion for the public, and inputs were received from the various stakeholders, and the final rules were notified on 31st of October 2017. Ideally, the deadline for filings would have been November 2017, as the rules are applicable for the period ended 31st March 2017. However, considering the short time period available for preparation of master file and CbCR, for the first year, the deadline has been extended to March 31st, 2018. Now, key recommendations were taken from the stakeholders and a lot of inputs were received from the industry to increase the threshold for compliance of master file, as well as bringing the timelines in line with global requirements. However, the threshold in India for preparation of master file is low. So there may be situations where globally master file is not required to be prepared. However, for India requirements, you may have to prepare a master file. The detailed rules for master file are contained in 10DA as well as CbCR, its rule 10DB. We move on to next slide to see what the thresholds for CbCR and master file are. As mentioned by Wendy, that CbCR is a minimum standard, and hence India being a signatory to the BEPS project, the limit and threshold for CbCR is in line with the global requirements. So the limit for preparation of CbCR is 750 million euro, which is equivalent to INR 5,500 crores. So this is applicable to a consolidated group revenue. The definition for revenue has been laid down by OECD in the BEPS project. So if the group revenue exceeds this threshold in the immediately preceding previous year, the Indian parent entity or an alternate reporting entity who has been designated so by the group resident in India will have to file the CbCR in India electronically. Of course, there are some compliance requirements for resident entities which are part of the foreign MNC groups, which we will see in the next slide. But before that, coming to master file. For master file, again, there are thresholds which have been specified. Here, if the group consolidated revenue is 75 million euro for that accounting year, and the value of international transactions is more than 7.5 million euro. If these two thresholds are met, master file is required to be prepared. Or alternatively, your revenue consolidated of the group is 75 million euros, or you have an intangible related transaction of 1.4 million euros, still master file may be required to be prepared. So these are the limits which have been specified for preparation of master file, and as the deadlines are fast approaching, you may have to start preparing on these. Now on the next slide, you see the forms which have been specified by the government in India for the purposes of filing. The master file has to be electronically filed, and the due date for that is March 31st, 2018 for this particular year. However, from next year onwards, the deadline would be November 30th. Now, in case a group has more than one entity who is resident in India, all of them need not file the master file electronically. However, they can designate one of the entity amongst themselves as the designated entity who is responsible for filing the master file. However, you have to intimate to the tax authorities a month in advance of the due date as to who this designated entity is, and there is a form which has been notified for this, which needs to be filed electronically. CbCR, if you are an Indian parent or a designated entity by the group, you need to file the CbCR. This format of CbCR is in line with the global template which Anuj is going to discuss in some time. This electronically has to be filed by March 31st, 2018. Now, in case you are a subsidiary of a foreign MNC group, you have to merely file an intimation with the tax authority as to who your parent is, who is going to be responsible for filing the CbCR, and if you're not yourself the alternate entity, details of the alternate entity in absence of the parent filing, who the alternate entity who is going to be responsible to file the CbCR. This notification has to be filed 2 months in advance, which is Jan 31st, and this notification also has to be filed electronically. Now moving on to the next slide, we discuss what are the consequences of non-filing of master file and CbCR. In case of master file, the penalty is 500,000 INR. There is also a penalty which is related to the value of international transaction, as master file is a part of the documentation requirement in India. CbCR, if you fail to file the CbCR, there is a penalty of 5,000 to 50,000 rupees per day. In case there are certain questions which the tax authorities want to ask you, you have a time period of 30 days to respond, and if you do not respond within this time, again similar penalties are going to apply. We do not have separate local file regulations in India, but we have the transfer pricing study report, which has been in prevalence since 2001, and this needs to be filed as and when it is called for by the tax authorities during the assessment process, but it has to be in place contemporaneously by the time you file your returns as well as your Form 3CB. At this stage, we move to the next slide, number 16, where we discuss the contents of the master file. The master file consists of two parts. There is part A and there is part B. Part A of the master file consists of basic information about the group, and this has to be filed by all entities in India. So all constituent entities of an international group who are resident in India will be required to file part A of the master file, irrespective whether you meet the thresholds which have been discussed by me before or not. However, part B, which is the main content of the master file, has to be filed along with part A, the entire master file, by those entities which fulfill the thresholds that we have discussed in the slide earlier. Now, the broad contents of the master file are very much in line with what has been recommended by OECD and globally, which is giving information about your organization structure, about your business, about your intangibles, about your financial activities, financial and tax positions. So the information that they have asked in a master file is much more exhaustive and large as compared to what we have been used to providing in the transfer pricing study report. And now I hand over to Anuj to discuss in detail the contents of the master file and how it differs from the global norms. Over to you, Anuj.
Thank you, Vaishali. On slide 17, I'll be discussing the key differences between the UK OECD approach to the contents of the master file against the Indian approach. But first, I'll quickly run through the UK OECD requirements of the content of the master file. I won't run through all of the requirements, but we will include a leaflet which will cover these details off in a little bit more detail. Now, the overall headings are similar to the Indian contents of the master file. They start with the organizational structure, which will include a chart illustrating the MNE's and legal and ownership structure and the geographical location of operating entities. It then goes on to the description of the MNE's businesses, which will include a list and brief description of important service agreements between members of the MNE group. It will also include a brief written functional analysis describing the principal contributions to value creation by individual entities within the group, and a description of important business restructurings in the year. It also then goes on to talk about the MNE intangibles. I'll cover this point off in a little bit more detail further down the slide. Also important is the MNE's intercompany financial activities, which I'll also cover off later on. So, per the OECD approach, the master file only requires taxpayers to provide basic information about their organizational structure. The Indian Tax Authority, however, will require you to disclose more detailed information, including all entities in the group alongside their address. This includes entities that do not trade with the Indian entity. Another key difference between the two standards relates to intangibles. The OECD requires a description of the overall R&D strategy, important intra-group agreements, a description of the transfer pricing policies, and an analysis of the development, enhancement, maintenance, protection, and exploitation activities relating to the intangibles. India, however, requires even more details, including the name and addresses for all owners and developers of intangible assets. Another key difference is the requirement to disclose the top 10 unrelated lenders to the group, which may pose the group with further commercial issues. There are a number of areas, however, where there is overlap with the OECD requirements. This includes the supply chain of the 5 largest revenue-generating products or services, or anything that represents more than 5% of the consolidated group revenue. If you would like us to, we'd be delighted to share a leaflet that covers the requirements of the UK and OECD master file, plus the Indian requirements as well. Please let us know at the end of the webinar. Please also note, as was mentioned by Wendy earlier, that there are additional requirements for local files in the UK and additional transfer pricing requirements in India. However, these won't be covered in today's session in detail. Moving on to country-by-country reporting. As mentioned earlier, country-by-country reporting is one of the minimum requirements of the OECD's BEPS initiative. The OECD has recommended that it only applies to groups with revenues in excess of 750 million euros. This has been upheld by the UK. Whilst the threshold may appear low, it is intended to cover 90% of global revenues. The filing deadline for the first CbCR to be delivered under UK legislation is 12 months after the end of the first period to which the country-by-country report relates to. That will begin from the 1st of January 2016. The deadline for notification is either the later of the end of the period to which the report relates, or the 1st of September 2017, which is, as I'm sure you'll all appreciate, we've already passed. So, for example, if the group's reportable period is the 31st of December 2016, the deadline would have been to notify on the 1st of September 2017. However, if the group's reportable period was for the 31st of December 2017, then the deadline for notification would be that date. Now, there is talk of widening the scope of country-by-country reporting in the future, with many tax authorities, including the Indian tax authority, wanting to add on other items. Now, moving on to slide 20, the CbCR is split into 3 parts. Tables 1 and 2, which contain prescriptive information, and Table 3, which contains descriptive information and is for assumptions. For Table 1, you would split revenue into unrelated and related party revenues. You'd also provide a number of other items, including profit before interest and tax, and the income tax paid and accrued. The idea is that it's supposed to give you information on where you have a presence, how much revenue you derive from group activities, how much tax you are paying, how many people are there, etc. It is designed to help tax authorities to risk assess the group. Table 2, on the other hand, is given entity-wise. It is where you can say where you are incorporated and where you are tax resident. It will also tell tax authorities what these entities do. Now, Table 3, as mentioned before, is more descriptive. It is considered a mechanism that will allow taxpayers to strategically provide the context for Tables 1 and 2 of the CbCR and explain any specific abnormalities or outliers. It will also give taxpayers the opportunity to describe what type of business it is. For example, if you tick the research and development box, you can then specify that as contract research and development. It will also allow you to explain why your results are different per different accounting standards. For example, you may follow UK GAAP, IFRS, or Indian GAAP, which may treat certain items differently. The key here is the consistency with your transfer pricing documentation. I'll now hand it back over to Vaishali on slide 21 to discuss CbCR requirements in India.
Thanks, Anuj. So as mentioned earlier, the limits for CbCR are very much in line with the global norm, as well as the templates are exactly same as compared to what has been discussed by Anuj. And the CbCR has to be filed electronically. So if you are an Indian parent in India, or if you are an alternate reporting entity designated so by the group, you will have to file the CbCR in India electronically. Electronically, the form goes to Director General of Income Tax Risk Assessment, which is at Delhi, and this is a separate jurisdiction that has been set up especially for the purpose of CbCR. And at various discussions with the tax authorities, they have indicated that the information in CbCR is highly sensitive and confidential, and it will be treated with a great amount of safeguards, and this information will not be openly shared with transfer pricing officers, and it will be used only for the purpose of risk assessment to identify groups where there is any huge amount of risk that has happened. So in case you are an entity and the parent is based in a jurisdiction with whom the information exchange has failed or there's a systematic failure, then you may have to file the CbCR in India. So if you are a resident entity, subsidiary of a foreign MNC, the parent is based overseas, the parent files the CbCR in their jurisdiction. Here you have to merely file a notification which informs the tax authorities who your parent entity is, where is the parent entity based, and certain other information, which informs the tax authorities as to from whom they are supposed to get the CbCR. The tax authorities of the parent entity exchange the information of CbCR with the Indian tax authorities, and hence these entities do not actually file the CbCR in India, but merely the notification. So this is the development with respect to CbCR in India, and I now hand it over to Wendy to discuss the next slide.
Thank you very much, Vaishali. So what we'd like to do now is to move on a little bit to some of the practical considerations and what's this going to mean for everybody, and in particular, when are you going to have to think about doing some of these extra pieces of work. I'd also just like to pick up, as Vaishali's just been mentioning about the Indian filings of country-by-country reporting, some news for UK groups or groups where the UK is filing CbCR as a surrogate parent. Some of you may have known that the portal for HMRC for filing your CbCR has been closed for maintenance, I guess, for the last few weeks, but it's now open. So I guess what that means is there's no excuse that we couldn't file our country-by-country report because the portal wasn't open, because lo and behold, it's now open just in time for Christmas. So, so the deadline for UK filings, as Anuj was mentioning, is the 31st of December 2017. You have to file in an XML format, which is very specific computer language. So if anybody's bumping up against that deadline and struggling, do talk to us. I guess really, though, the thing that we need to bear in mind here is that there are a lot of changes of rules that are going on in lots of countries. I was just hearing this morning about some extra time being given in Australia, for example. So some countries are allowing extra time, I think Ireland and so forth. So there have been countries that have allowed extra time. UK and India are not among the group of countries that are giving you extra time at the moment. So apart from the 31 March deadline that Vaishali mentioned. So, but I guess the thing about that is to say, you know, there is extra compliance burden. There is a lack of standardization in relation to the master file in India compared to what you might do in some of the other countries. And you're going to have to do this by the March deadline, which will probably loom up fairly swiftly. And in fact, in some countries where you're not even necessarily required to maintain or file your master file locally, you are going to have to do it in India, even where there are potentially no transactions, no international transactions. So there's a lot to think about here. And the other thing to bear in mind is what is your data going to show when you do file it, because there is a school of thought that says that tax authorities are just going to get swamped and they will just have so much information filed with them that they won't know what to do with it. I think that may be the case for a little while on country-by-country reporting. I mean, again, the UK has got 45 agreements to exchange their country-by-country reports. Vaishali might comment in a moment about India's exchange of information, but there's going to be a lot of reports flying around, and a lot of master files are going to be being prepared in addition to all the documentation that we've already got. So where do we see potential challenges, particularly for UK-India businesses? Well, one of them might be around this area of intangibles. As you could see from what Anuj went through, and we can send you a link to a flyer with all this information in detail, so I realize we've rattled through it rather fast, but there are some potential challenges that we may be seeing around intangibles. For example, if there's a UK business and India is involved in developing intangibles, that is going to be recorded, and you might expect a challenge from the Indian tax authority saying, aren't we developing intangibles, shouldn't we have some different amount of profit? And vice versa, the UK is going to see a lot more of other countries as well, and they may take a different view, because they may say, well, you know, we think we've got the significant people functions, and India might say, no, we think we have. So there's a lot of change going on in that area. You're also, as Anuj says, well advised to think about reconciling. So if you're filing information that does not tie up with your local tax return, for example, because you've done a top-down approach, you really need to think about reconciling that. And in the CbCR, don't forget, those of you who have to do those, income tax has to be reported on both a paid and accrued basis, and you may have, for example, a calendar year end here in the UK, but you will have a 31 March fiscal year end in India. So you're going to have potentially 4 different amounts of reporting for a simple thing like how much tax did you pay. And then finally, on that one, the main business activity one is rather a difficult one, because you've got to choose which box you're going to tick for each entity. And you may have some entities that do lots of things, but again, you may find that there's challenges on administrative management and support services. So if you're getting management charges flowing backwards and forwards in your group, you're probably already seeing quite a few challenges, but this may increase if you start ticking the box that says lots of group entities are doing administrative management and support services, particularly if you have centres of excellence within your group or captive service providers. So, okay, so that's some of the challenges. I guess the next slide and the last of these formal slides that we've got for you is just to say, well, are there any opportunities? Is there any good news? So there is some good news here, I think. There is convergence around the country-by-country reporting rules, and I think the OECD and the wider group of countries that have been involved in that process should be congratulated to say, you know, there has been a large degree of convergence, and pretty much everybody has agreed to do this, including countries like the US, where at one point we thought they may not. They're now doing CbCR, and any of you with US parents, you may have already filed your country-by-country report for the US. So that's good. To a certain extent, the master file as well is convergent. So Anuj has pointed out some of the differences, and again, these are on our flyer. So when you come to the very end, just as you sign out of the webinar, you'll be asked a couple of polling questions, one of which is a question for you because we're genuinely interested in your answer, but the other one is to say, yes, please send me all these goodies that Anuj was mentioning. So say yes to that if you do want them. Now, I guess also the other thing to think about is this issue about two-sided analysis. And I think there's been, for some of you, there's been a feeling in the past that you didn't know, you didn't really want to expose yourselves to too much risk of challenge in some of your larger and more important countries. So you may have, shall we say, slightly over-complied in one or two jurisdictions. If you've had, for example, an advanced pricing agreement in India, these have been really popular for a good reason, but if you've gone for a unilateral one, again, it might have been tempting to say, let's agree a sort of fairly high markup, because we only have to convince India, we don't have to convince anybody else. But where we might now be is a situation where you can go and re-look at your comparables and your benchmarking. I'm sure Vaishali and the team will be really happy to help you with that. And in relation to advanced pricing agreements, those of you who are doing these for the purposes of having certainty for a 5-year period, you might think about changing your tactics and want to move to a bilateral APA so that you get both sides agreement. One of the other things that you may or may not have picked up is that in the master file, which remember goes to every single jurisdiction, you are going to have to report any unilateral APAs or rulings. So, but if you have bilateral APAs, the idea is that the two tax authorities have slugged it out between them and got to, the elusive holy grail of the arm's length answer. So if you have a bilateral APA, you don't have to disclose it. If you've got a unilateral, you do, and you might start getting questions from all sorts of countries around the world. Well, you've got this unilateral arrangement in one particular country, why can't I have the same? So from our point of view, we've always said it's a really good idea to take a two-sided approach, to make sure your documentation tells your story in the right way, and actually really that when you say, I've got the most appropriate method and I've characterized my entities correctly, that you would be happy to stand up and defend that, not just in the country where you're filing that documentation, but in the other countries as well. And finally, it's worth remembering that the best way to approach your transfer pricing documentation, if you've got a limited amount of time and budget, and of course who hasn't, is to take a risk-based approach. So look at which countries you've got the most exposure, the largest amount of transactions, the largest amount of interactions with the rest of your group, and where, if you've got an area that may be subject to scrutiny and challenge, like service charges or management fees. So, and then having thought about all of that, then decide where you're going to put your effort into doing documentation and in which countries you're going to just get ready to have it prepared if and when you get a question. So that's our perspective. That's some of the things that we have been hearing. And I'd now like to turn over to Anuj or Vaishali to see if you've picked up any of the questions that have been coming in. Shall I start with you, Vaishali? Have you got any questions that you would like to share with everybody?
No questions here. Anuj, any questions at your end?
Hi, yes, we have received a few questions so far. Thank you very much, audience. The first question is, and Vaishali, this one may be directed at you. So the question is, what time period should the Indian master file be prepared for? Should it be prepared for the Indian financial year or the group financial year?
Yes, so the time limit, the first year is going to be 31st March 2017, but the master file gets prepared at the group level. So let us assume that in case it's an Indian parent, then it would be 31st March 2017 that they prepare the master file for. But if it is a foreign group or any group where the calendar period is December 2016, then the information would be for that accounting year which is being followed by that group. So they may whatever information that has been asked for in the master file regarding business restructurings or intangibles, funding, etc., all that information will be based as of December 16 or any accounting year of the parent.
Okay, so Vaishali, could I just to clarify on that then, if a group has already done an OECD-style master file for the December year end, could they just add to that for the extra Indian requirements?
Yes. So Anuj has already discussed in detail the deviations. So as long as those aspects of Indian master file are taken care of, you can leverage on the overseas master file report.
Perfect. Thanks for that, Vaishali. My second question is from a group with operations in the United States. I'm going to hand this one to Wendy. They're asking, what if their country-by-country report was filed in another country? For example, what if it was filed in the USA? How would that impact their filing?
Okay, so essentially the whole point about the country-by-country reporting is not to have this being created and filed in a plethora of countries around the world. So we did have a period, as I said before, with the US where we weren't sure whether there was going to be the opportunity for voluntary filing for their FY 2016, so calendar 2016 years, because in the US, the CbCR requirements don't actually come in until the following year. So there was a lot of concern from people about, well, what are we going to do? We're going to have to file in every other country underneath. And some people were thinking about which entities were going to be their surrogates. Now, what we have found is that our US parented groups, probably most of them have taken advantage of the opportunity to do a voluntary filing with their tax return that they would have just sent in September. So if your group has already done that, then you don't need to do extra filings in UK, India, or wherever else you have operations. But a number of other groups have decided to notify a surrogate filer, some of which have chosen the UK if the UK might be their international holding location. So for those ones, you're going to have to file in the UK, and the deadline there is the 31st of December. Perhaps I could just at this point just ask Vaishali, because another point that's come in is that on the OECD's website, there are some quite useful links in relation to all this stuff. So again, if anybody wants a link to those, we can send it to you. But one of the things is that the website shows which countries have exchanges of information. And in relation to the US, for example, the US and UK do have exchange of information, so that'll all be automatic with the CbCR. For a number of other countries, the US has not quite got round to doing all of their exchange of information agreements, but we understand that they're working on that and that it's hopeful that they will. So you probably shouldn't have to worry, keep an eye on this, but you probably shouldn't have to worry about doing extra filings. But Vaishali, in India, what's the position about exchange of information if people have filed or are going to file in India?
Yes, so India is going to be a signatory to the multilateral competent authority agreements, which are specially going to be entered into for exchange of CbCR with various countries. And based on discussions with the tax authorities, we are of the view that maybe next 1 or 2 months, this should the process should have got action for the exchange of CbCR.
Thanks very much, Vaishali and Wendy. I think we only have time for 2 more questions. We have received other questions, and we will try to respond to these by email. So just moving on to the final 2 for today. So how does the existing transfer pricing requirements in India change as a result of these new rules? I think that one's over to you, Vaishali.
Yes, Anuj?
Yes. So the question is whether you have to, whether your existing rules on documentation are going to change. So we're used to the having to do the accountant's certificate and so forth in India for Indian documentation purposes. Is that changed in any way, or is that exactly the same?
So those regulations are exactly the same. As I mentioned, we have a local certificate Form 3CB. The deadline is the return filing deadline of November, as well as the transfer pricing study report, as I mentioned, needs to be contemporaneously maintained in India. So those regulations are untouched.
Okay, and I guess supplementary to that sort of sub-question on that is what about penalties? Because the financial penalties for not filing things like the master file, I mean, you know, they're not nothing, but they're not huge in some respects. So, but are there other penalties that could come into play if groups decide, well, it's all just too much trouble and I don't want to do the extra master file work for India? What's the downside of doing that, if any? Maybe that's a reasonable approach somebody might want to take.
Yeah, so master file regulations have been notified to be part of the transfer pricing documentation regulations itself, which means that if you do not comply with the documentation requirements, the penalties are linked to the value of international transactions. So if you don't maintain the transfer pricing documentation, it is 2%, and if you don't furnish it to the tax authorities when you asked for, there's additional penalty of 2% as well. And in India, it is legally the liability of the taxpayer to maintain the documentation to justify the position that his transactions are at arm's length, and if he's unable to do so, then the transfer pricing authorities can make an adjustment. So there can be penalties linked to the adjustment as well. So considering that a lot of those penalties are linked to the value of international transactions, they are going to be quite hefty, and it makes sense to have the documents.
Oh, okay, so you mean percentage-based penalties potentially, as well as the monetary penalties that you mentioned in your slides?
Yes.
Thank you.
Thank you, Wendy and Vaishali. Now, over to the final question for today. This one's with regards to Part A of the Indian Master File. The question is Part A of the Indian Master File applicable to all entities? And what about UK and UK operations? First over to Vaishali, and then I'll hand it over to Wendy afterwards. Vaishali, do you want to take this question?
Yeah, so as I mentioned, the master file in India has Part A and Part B. Both Part A and Part B have to be filed by those entities which fulfill the thresholds that we discussed. However, if those thresholds are not met, still entities, that is all entities, will have to file Part A, which is the basic information about the master file. So that basic information has to be filed by all entities.
Thank you. And Wendy, if you wanted to take the second half of the question.
Yes, so in relation to the UK, you do not have to file your master file at all. So, it's a bit sort of the dog that didn't bark, because you need to have it, or you need to have enough information to show that your transfer pricing is correct and to support your UK local file, but you also, in many cases, are going to have to do a master file for the rest of your group anyway. So, or even though there isn't a filing requirement for the master file, that most groups are producing it. And there can be some areas of this that can be quite tricky compared to what people might have done before. So the other thing that's been allowed in the UK has been the EU TPD, the EU transfer pricing documentation, which had a sort of similar sort of master file and local file element to it. But as Anuj was saying earlier, the new master file has got a lot of different information in, and it's really supposed to be about the group rather than about particular entities within it. So when it says, you know, details of your top 5 products and services, a supply chain story or picture, you know, these things actually can be quite difficult to find. I mean, the other thing is the DEMPI analysis, this develop, enhance, maintain, protect, and exploit part of the master file. You know, you might initially think, oh, all my IP is held in wherever it is, and so that's easy. But actually it isn't, because the question is, who's doing the development? Who's doing the enhancement? This is all about significant people functions as well. So who's doing the maintaining? Who's deciding on the strategy? Who is protecting your intangibles, whether they're hard intangibles or soft? And who is exploiting them, which may well be all your group companies. So again, this means more disclosure and more thought from you, because if you just send something in saying, oh, everything's in country X, then you are going to get lots of questions. So it's probably worth thinking about what the questions are going to be before you finalize your master file. So I guess that probably takes us to want to make sure that we don't run out of time for people to do the polling questions. So is that it for our questions from the audience? Okay. So what I'd like to just remind you about now is that you can get hold of a leaflet with these requirements. You've also got all our contact details on here. So you've got our emails and our phone numbers in case you want to ring any of us up. And please do feel free to do that if anything occurs to you afterwards, that, you know, burning question that you should have asked or that you would have liked to know the answer to. We have got 2 polling questions for you. The first one, as you leave the webinar, they're going to pop up. So the first one is, we will give you the answers to this question, or the results of this question, if you answer yes to question 2 kind of thing. But the first one is to say, do you expect that your group will have to do more or less work as a result of the BEPS changes to transfer pricing documentation? The reason we're asking you this question is because originally the whole, the kind of quid pro quo on the BEPS sort of extra work was supposed to be that some things were going to get easier and more streamlined. And we're starting to see in a number of countries some quite different deadlines and some quite different requirements for some of the documentation elements. And we're wondering what your views are on this, because we do participate in business at the OECD, as I said, the EU Joint Transfer Pricing Forum, and you know, in India we talk to the Indian Tax Authority, in the UK we talk to HMRC and the Treasury about policy. So we do, you know, have a voice from the wide range of clients that we have, so we're interested in your view there. So that's the polling question, and then question 2 is just going to be, do you want us to send the slides and the answer to the other polling question. I hope you have enjoyed today's session. I'd just like to say thank you very much, especially to Anuj and Vaishali for their help on the presentation. Thank you very much, both of you, very clear explanations. So thanks for that, and I would now like to hand you back to the webinar operator. Thanks.
Thank you very much. So, ladies and gentlemen, with this we conclude the webinar for today. You may all disconnect your lines now. I will request you all to kindly submit the questions which will just appear after the session gets over. Thank you very much. Wish you all a great day ahead.